If you're one of the millions of people who've taken financial advice over the last, 40 years,
Mm-hmm.
whether it's from a book or an advisor or just your company's 401k plan, you've heard the same thing
Yeah.
relentlessly.
Oh, yeah. Just buy the S&P 500.
Exactly. Set and forget it.
How?
It was sold to us as the ultimate free lunch of capitalism.
And for a long time, it really was. I mean, it let
Yeah.
the average person own a slice of America's greatest companies, skip the high fees, and just put retirement on autopilot. It democratized finance, and for decades, that was a huge, huge win.
Absolutely. A huge win. But, and this is why we're doing this deep dive,
Right.
we have to introduce a dangerous truth right at the top here.
Yeah.
The nature of the market has fundamentally changed. A strategy, it works flawlessly until everybody does it. And we are well past that tipping point.
And we really need to quantify what that tipping point looks like because it's not a straight line. I mean, look, when 5% of the market is passive, the free ride is fantastic. It works because the other 95%, the active managers, they're doing all the hard work of setting prices and analyzing companies.
Right. They're providing the price discovery.
Exactly. Now, when 50% is passive, it starts to get crowded. It's a crowded trade. But when 90% of the daily flows, and that's the key word, the flows, the new money coming in every day, is passive,
Which is where we are now.
which is basically where we are now.
Yeah.
You are looking at what amounts to a systemic suicide pact.
Suicide pact. That's a really stark term, but it gets to the heart of the problem, doesn't it? The market isn't a voting machine anymore.
No.
It's not weighing the value of a company, its profits, its future. It has morphed into something else entirely, a mindless flow machine.
A mindless flow machine. That's perfect.
We're all just pumping billions of dollars every single paycheck through automatic enrollment in our 401ks into this blind algorithm.
And that algorithm's only job is to buy. It doesn't care about the price. It doesn't care about valuation. It is completely, utterly divorced from economic reality.
And this relentless, nonstop flow has quietly built what might be the largest bubble in history.
And it's a strange kind of bubble because it wasn't built on, wild speculation in chat rooms. It was built on responsible automatic participation. You, the average person saving for retirement, you are the fuel for this machine.
So our mission today is to really pull back the curtain on this passive bubble. We need to show you exactly how these index funds have basically destroyed price discovery.
How they've created this dangerous concentration at the very top of the market.
And why your supposedly safe diversified retirement fund isn't diversified at all. It's unknowingly become a very concentrated and very fragile tech momentum fund.
That's the core of it.
Yeah.
So if the market's broken, what does that broken mechanism actually look like?
Yeah, let's start there.
The main concept you have to grasp is that the market has become inelastic.
Inelastic. Okay, what does that mean in simple terms?
Well, think back to your basic economics. In a normal, rational market, a stock's price is supposed to be set by the quality of the company.
Sure, its earnings, its assets, what it's likely to make in the future.
Exactly. That price is set by active analysis. But in an inelastic market, which is what we have now, the price is determined almost entirely by the quantity of flows.
The amount of money being forced into it?
Precisely. If the flow of money is mandated to buy, the price has to go up. It has to. Because the buyer isn't making a choice. They're required to buy no matter what the price tag says.
Yeah.
The price elasticity has just collapsed.
Okay, but hold on a minute. I can hear people asking, $5 billion in index inflows sounds like a lot, but the S&P 500 is worth tens of trillions.
Right.
How can those flows really move the needle against all the other active trading happening every day? Are we overstating the power of the machine here?
That is a fantastic and critical question because it gets right to the structural fragility. So yes, the total market cap is huge, but the amount of stock that's actually available to buy on any given day, the actual float, the liquidity, is tiny compared to these mandated flows.
Ah, I see.
So when an index fund gets a few $1 billion, it has to place huge systemic orders that have to be filled. And here's the kicker. The traditional sellers, the active managers who might sell if the price gets too high or the fundamentals look bad.
Both been decimated. They don't have the capital they used to.
They've been starved. So the supply of shares dries up really fast. The passive flow doesn't have to move the whole mountain. It just has to push on that very thin top layer of available stock.
Yeah.
And that quantity of flow just completely overwhelms any remaining quality analysis.
So let's say it's the 15th of the month. Paychecks go out. Millions of 401k deposits hit the system automatically.
Yep.
The price of the index has to go up, even if, I don't know, a Fed just announced a disastrous rate hike 5 minutes earlier. The market is just blind to the news.
It is functionally blind to bad news. The algorithm doesn't have a valuation check. It doesn't have a news feed. It has one input
Cash in.
and one output.
Yeah.
Buy these 500 stocks in these exact proportions.
Yeah.
This is why you see the market just shrug off major geopolitical events or terrible economic data. The mandated flow is simply bigger than the rational price discovery mechanism now.
Okay, let's unpack that shift. The famous man walking a dog analogy seems perfect for explaining this.
It's the best illustration there is for this.
Right.
For decades, the system worked like this. The man was the active investor.
Right. He's the one doing the work, looking at the path, checking the map, setting the direction. He sets the price.
Exactly. And the dog on the leash, that was the passive investor. You know, the dog runs around a bit, sniffs a fire hydrant, but at the end of the day, it's held by the man. It follows the direction he sets.
So the passive investor just got a free ride on the man's hard work and intelligence.
That was the efficient system. The little dog didn't pull the man off course. But today, that whole mechanism has just been violently flipped upside down.
How so?
The dog is now a 500-pound beast of institutional mandated index buying power. And the man is a 50-pound lightweight holding a frayed leash.
So the dog is dragging the man?
The dog is dragging the man, wherever the sheer mindless weight of the passive flows dictate. The active investor, the guy who should be setting the price, is just being swept along for the ride.
And the brain of that giant dog is just that one simple command, that passive mandate.
That mandate is the fundamental flaw. A passive fund's only job is to track the index as cheaply as possible. The programming is brutally simple. Get cash, buy the index in its market cap proportions, do it right now at any price.
I don't care about valuation at all.
They don't engage in any analysis. They don't care.
So if Microsoft is trading at, say, 30 times future earnings, which a lot of active managers would say is just absurdly expensive, the passive fund just buys it.
It absolutely does not care. If money comes in, it buys Microsoft. And at the same time, if there's a great industrial company trading at, I don't know, 6 times earnings with a rock-solid balance sheet, the algorithm gives it almost nothing.
Because its market cap is smaller.
Just because its market cap is smaller? This inelasticity is how prices get so detached from reality. The big 7 can get irrationally expensive, while the other 493 can become irrationally cheap.
Which is why that old saying, the market looks 6 months into the future, that's broken now.
It's deeply flawed. The market's ability to look ahead depended on active managers seeing risk and selling. Now, the economy could be flashing red lights everywhere, manufacturing slumping, credit crunch coming.
And the S&P 500 can still hit an all-time high.
It can still hit an all-time high, because if it's the first of the month and pension funds are mandated to buy $20 billion worth of stock, they buy it. The flow dictates the price, and the fundamentals get ignored.
The man is being dragged toward a cliff, and he can't stop it because the dog is just too big and too blind.
And if that analogy is the theory, then the Tesla inclusion back in December 2020, that is the definitive, quantifiable proof that this machine is broken.
Okay, let's spend some real time on this, because this wasn't some minor adjustment. This was a massive capital shock to the system.
It was a perfect clinical case study in self-inflicted damage. I mean, Tesla at the time was already a huge, volatile, highly valued company.
Right.
When the S&P committee announced it was being added, nothing about the business changed. They didn't invent a new battery overnight. But a clock started ticking for every passive index fund in the world.
And that's when the speculators saw their opening. This is the wealth transfer you're talking about.
Precisely. The smart money knew, with 100% certainty, that on a specific day, all these index funds had to buy a massive, predetermined amount of Tesla stock.
So they front-ran it.
They front-ran the trade. In the weeks leading up to the inclusion, speculators pushed the price of Tesla higher and higher, knowing they had a guaranteed price-insensitive buyer waiting for them at the finish line.
So the passive investor, the person with the 401k, was forced to buy Tesla not at a fair price,
Not at all.
but at the exact artificially inflated peak price that the speculators had just created.
On inclusion day, passive funds were forced to buy something like $80 billion worth of Tesla stock.
No.
It was one of the largest single stock adjustments in history. Think about the pure mechanical inefficiency of that.
It's staggering.
They had to buy aggressively at the top, handing an immediate profit directly to the speculators who set the trap.
Okay, and here's where the structure of the S&P 500 becomes its own worst enemy. To get that $80 billion to buy all that expensive Tesla stock, where did that money come from?
It had to come from somewhere. And it came from the mandated forced selling of the other 499 companies in the index.
Wow.
To keep the market cap balance perfect, the algorithms had to liquidate portions of everything else. They were systematically selling profitable, stable, maybe even cheap companies
The bedrock of the U.S. economy.
to buy the most extensive, most hyped-up momentum stock in the entire index.
That is not value investing. It's not diversification. That is buy high, sell low on an industrial automated scale.
It is the dictionary definition of inefficient capital allocation. The passive investor, the one who thinks they're being safe and low cost, is unknowingly playing the part of the sucker at the poker table.
And they're paying that price every single time the index rebalances or a new hot stock gets added.
Every single time. The structural weakness guarantees that a little bit of wealth is constantly being bled from the 401k and handed directly to the nimble speculator who understands how the machine works. The promise of safety is actually a guarantee of being exploited.
So this broken flow machine, it doesn't just create these one-off events like Tesla. It creates a permanent imbalance, this top-heavy bubble.
Yes. And to understand that, you have to remember how the S&P 500 is built.
It's market cap weighted.
It's market cap weighted,
Mhm.
which just means the bigger the company's total value, the bigger its slice of the index. It's a structure that aggressively rewards size and momentum.
And that one technical detail is why any idea of diversification today is, well, it's an illusion. Let's just state the shocking number again, the Magnificent Seven problem.
We haven't seen concentration like this since the absolute peak of the dot-com bubble. We're talking about 7 companies: Microsoft, Apple, NVIDIA, Amazon, Meta, Google, and Tesla.
Okay.
For every single dollar you automatically put into your S&P 500 fund today, almost 30 cents of it goes straight into just those 7 names.
30 cents, a third of your money. And it's 7 companies that are all basically tech and momentum stocks. You're not buying the haystack anymore. You're making a huge concentrated bet on the 7 biggest needles.
And that creates this runaway feedback loop. It's a self-fulfilling prophecy. Here's how it works. The index buying pushes the big 7 stocks up.
Because they get the biggest share of the money.
Right. Then as their price goes up, their market cap gets bigger, which means they become an even bigger piece of the index.
So the next time money flows in,
The algorithm is forced to buy even more of them, which pushes their price up further, which makes them an even bigger piece of the index, and on it goes.
so the most expensive stocks just keep getting more expensive and more dominant, not because their business is necessarily justifying it, but simply because of the flow dynamics.
It's an acceleration mechanism that pushes momentum to irrational extremes, which leads to the inevitable conclusion. If you think you own a diversified piece of the American economy, you're wrong.
You own a tech momentum hedge fund.
That's exactly what you own. It's just packaged and sold to you as a safe, boring index fund. The risk profile is completely different from what was promised.
But okay, let's play devil's advocate. The whole point is that it's safer, right? Even if I'm buying high, I own the whole market, and history shows that beats trying to time it. Isn't this concentration risk just the price you pay for guaranteed market returns?
That's the argument, but it relies on a history that isn't relevant anymore. The last few times the S&P 500 got this top-heavy, back in the 70s, back in the 90s, it was always followed by a massive reversion.
Meaning the top fell and the rest of the market came up.
Exactly. The value stocks rose to take their place. The risk today is that the concentration is so extreme, and the active capital that's supposed to catch that falling knife is so small that the reversion won't be a gentle rebalancing. It'll be a catastrophic collapse. Your safety is based on diversification that just doesn't exist anymore.
Let's talk about the other side of that coin then. What about the other 493 companies, the industrials, the healthcare companies, the regional banks, the actual, broad American economy?
They are the victims of this. They're being starved for capital. If 30 cents of every dollar gets vacuumed up by the big 7, the remaining 70 cents get spread incredibly thin across hundreds of other companies.
So you have this paradox where the market is roaring, but most of the companies in it are flat or even down.
Exactly. The blind algorithm doesn't care if a regional bank is fantastically profitable and cheap. It might be trading at 5 times earnings, but because its market cap is a rounding error compared to Apple, it gets almost no new capital.
It's just left for dead by the momentum trade.
Completely left for dead. And the implication here is bigger than just your investment returns. This is a systemic economic risk. We have built the entire nation's retirement system on an inverted pyramid.
An inverted pyramid. Explain that.
The huge, heavy capstone at the top is the Magnificent Seven, and it's resting on this tiny crumbling base of the other 493. The stability of the entire structure now depends on the flawless execution of just 7 CEOs and their companies.
So if one of them stumbles,
Yeah,
if there's a regulatory action or bad earnings report, they just get out innovated?
the whole capstone crumbles. And because the passive funds have to sell proportionally to track the index, when that capstone starts to fall, the selling will be mechanical and automatic, and it will drag down all those other 493 companies with it.
Even the healthy ones?
Even the healthy ones.
Yeah.
The diversification safety net is gone. The entire system now rests on the shoulders of just 7 men. If the big 7 falls 30%, the average index investor loses that money instantly, regardless of how well the rest of the economy is doing.
So if the concentration is the flaw in the structure, the next question has to be, when it starts to wobble, how do you get out? The whole promise of an ETF is liquidity. You can sell instantly.
And this is maybe the greatest lie in modern finance, the liquidity mirage. The ETF wrapper gives you the illusion of liquidity. You can sell your ETF share on an exchange, sure, but the ETF is just a claim check for the underlying stocks. That transaction only works if the real market for those stocks can absorb the sale.
Okay, so if I sell my SPY shares, the fund manager has to go into the real market and sell actual shares of Apple, Microsoft, etc., to give me my cash back.
Right, and that's where the air pocket appears.
Okay.
When millions of nervous investors all try to cash in their chips at the same time, the fund manager has to liquidate a huge amount of stock.
Yeah.
And the critical question becomes, who buys it?
In a normal market, the active managers, the value investors, they step in. They see prices falling, and they see a bargain.
But we just established the active managers have been starved of capital. The ones that are left don't have the hundreds of billions of dollars needed to absorb a massive passive selling wave. And what's worse, all the other passive funds are selling too.
So you have 100 sellers and 0 buyers.
You have 100 mandated sellers and basically 0 buyers of last resort.
What does that look like in the real world on a trading screen?
It's not a gentle decline. It's a liquidity air pocket. Prices don't drift down a few percent, they gap down. The electronic market makers who normally provide bids, they just pull them. They see a tidal wave of selling coming and they step aside.
So a stock like Apple could be trading at $180 1 second.
And the next trade that actually executes is at $140, a 20% drop in minutes. Not because anything changed at Apple, but because the mechanism for selling is broken.
This is the Hotel California analogy. You can check out anytime you like.
But you can never leave. That's it. The exit door that looked plenty wide when everyone was coming in shrinks to the size of a mouse hole when everyone tries to run out at the same time.
And beyond just the liquidity risk, there's this really deceptive side effect of the passive system, the suppression of volatility.
Yes. Think of the constant passive buying as a big wet blanket draped over the market. It's steady, it's predictable, it's always there. So if some bad news comes out, that should cause a 4% drop.
But the passive buying pressure is still there, so
Well,
maybe it only drops 1.5%.
Exactly. It dampens all the moves, which keeps the VIX, the fear index, artificially low. And that breeds this incredible complacency.
Because everyone looks at the low VIX and says, see, the market is safe, it barely moves.
And that encourages them to take on more risk. They take on more leverage, they borrow money to invest, they use complex options, all because they believe the downside has been removed from the system.
But that calm isn't real stability.
Not at all. It's a compressed spring. We're sitting on perhaps the most compressed volatility spring in financial history. All of that energy that should have been released in small daily moves is being stored up.
And when the flows finally reverse.
When that first big wave of selling hits, the wet blanket is instantly yanked away, and all that stored energy is released at once. Volatility doesn't just rise, it explodes.
We saw a small preview of this with Volmageddon back in 2018.
Right, and that was just in the volatility products. Imagine that kind of explosion in the actual stock market itself. When liquidity disappears, volatility becomes this destructive force that wipes out anyone with leverage and forces even more selling. It's a vicious spiral.
So if this is a known structural problem,
Yeah.
what is the smart money doing about it right now?
They're buying tail risk protection.
Crash insurance.
It's crash insurance. They understand the mechanism that's suppressing the volatility is the very thing that will eventually break. So they're paying a huge premium for protection because they know that when this spring finally snaps, it's going to be violent and it's going to wipe out the unsuspecting investor who thought the index was safe.
Okay, this all begs the most obvious question. If this is so dangerous, if the concentration is this bad and the liquidity is an illusion, Why hasn't the SEC done something? Why is Washington asleep at the wheel?
It comes down to power. The sheer, unprecedented power of the passive giants, primarily BlackRock and Vanguard. They are no longer just participants in the market. They have become the market. And it's almost impossible to regulate them without regulating the entire American retirement system.
Put that power into perspective, what does their ownership actually look like?
It's everywhere. Between them, their funds own about 20% of the voting shares of almost every major company in America.
20%.
The biggest banks, media companies, defense contractors, you name it. They're the largest shareholder by default in huge swaths of the economy.
And with that size comes massive lobbying power, regulatory capture.
They've played a brilliant PR game. They've sold this narrative that index investing is democratizing finance. They tell Washington that they're providing a safe, low-cost, morally superior option for the little guy.
It's a powerful story.
It's a very powerful story. And it makes it politically impossible to challenge them. How can a regulator go after the companies that are supposedly protecting the retirement of millions of Americans?
So by framing their business as a moral good, they've created this huge blind spot.
Precisely. The regulators are asleep at the wheel because challenging Vanguard or BlackRock is political suicide. The smart money knows that systems this big and this politically protected, when they break hard.
And this dominance doesn't just affect the regulators, it's fundamentally changed how corporations are run, creating this corporate void.
It has. You know, in the old days of active management, shareholders were the police force of capitalism.
Right.
If a CEO was incompetent or the board was lazy, active managers, hedge funds, value investors would step in. They'd start proxy fights, demand change, fire people. It was a crucial feedback loop.
The active investor kept the company honest.
Yes. But now, the biggest shareholders are Vanguard and BlackRock. They have enormous power. But because they own thousands of companies, they don't have the time or the resources to police thousands of boards. Their business model is built on low fees, not active engagement.
So when it comes time to vote on things like CEO pay or a questionable merger, what do?
They rubber stamp it. They vote yes on almost everything. It's too expensive and time-consuming to do otherwise. They approve mediocre CEO pay packages. They ignore bad strategy because their only job is to track the index, not to make company #432 perform better.
So the key disciplinary mechanism of capitalism, the threat of being held accountable by your owners, is gone.
It's broken. And it's given rise to what people call zombie companies.
Zombie companies.
Corporations that are poorly run, loaded with debt, and should have been restructured years ago. But they just keep shuffling along because their biggest investors are asleep at the wheel and will always vote to maintain the status quo. Passive investing rewards size, not performance.
It's ironic, isn't it? They're celebrated for saving people money on fees, but they're creating this systemic risk and corporate mediocrity that costs the average investor far more in the long run. The cost is just hidden in the structure.
So we've laid out this picture of a broken, brittle, concentrated market. It sounds incredibly bleak.
Yeah, it does. But where there's this much distortion, this much inefficiency, there has to be an opportunity for people who are paying attention.
That is the silver lining. If the market is obsessively focused on just 7 companies and ignoring everything else, it means thousands of other solid companies are trading at historic, unjustified discounts.
They're just victims of the flow machine,
waiting to be properly valued.
So where should an investor who's awake right now be looking for that value?
You look at all the places that have been left for dead by the tech momentum trade. You look at small caps and mid caps companies too small for the index flows to really distort. You look at deep value stocks, companies that require actual balance sheet analysis.
The boring stuff.
The boring stuff. Energy, old line industrials, regional banks. The unsexy parts of the economy are trading at valuations that suggest the market has completely forgotten they even exist.
And this opens the door for what's called the mean reversion trade. This is what the smart money is positioning for, right?
Absolutely. The playbook is two-sided. You bet against the index, the overinflated bubble, and you buy the unloved, the value stocks that have been starved of capital. The bet is that eventually fundamentals have to matter again, and the huge valuation gap between the Magnificent Seven and everyone else will slam shut.
And when that crash hits, when that liquidity air pocket opens up, what's the goal for the investor who's prepared?
The goal is to be the person who understands the difference between a mechanical, forced sale and a fundamental business problem. When the panic starts, good companies get thrown out with the bad.
Right.
And your job is to be there with cash, ready to buy high-quality dollar bills for 50 cents, while everyone else is being forced to sell by the passive machine.
Which means the entire era of set it and forget it is over. This is the return of active decision-making.
It has to be.
Which brings us to the final, critical debate. If I accept the index as a broken bet, what do I actually do? Is it better to go back to picking individual stocks, or is the safest move just to hold cash?
I think the playbook for the next decade requires both, but it all starts with one thing: reducing your exposure to that broken structure.
Okay, so step one, how do you do that without just abandoning the market altogether?
The first simplest step is to reduce your exposure to cap-weighted indexes. If you still want broad exposure, look at equal-weighted funds like RSP. That one change immediately strips out the mega cap bias.
Because it treats every company in the index as an equal.
Exactly. It breaks that feedback loop that just keeps pouring money into the big seven.
Okay, so that solves concentration. Step two is actively looking for value.
Right. Actively hunt in those neglected areas we talked about.
Hmm.
Small caps, mid caps, companies with strong balance sheets that have just been ignored. Their valuations are lower and their risk is lower because they aren't inflated by all this automated buying.
Now for the big one, stocks versus cash. Step three, this speaks directly to surviving that liquidity crisis.
Step 3 is the most important. Hold a substantial amount of cash if you believe a reversal will create a liquidity vacuum. Cash is your weapon.
It's not a drag on performance.
In this environment, it's not a drag. It's a call option on panic. It positions you to be the buyer of last resort when the index funds are mechanically forced to liquidate good companies for cheap.
So cash is defense that turns into offense during the crisis. But what about the work involved? Do we all need to become stock pickers again?
That's step 4, and it's a cultural shift. You have to do your homework and become an active owner again. The entire passive movement was built on the idea that analysis doesn't matter. Well, now it matters more than ever.
Because the default vehicle is broken.
Exactly. The future requires looking at balance sheets again, understanding cash flows, and managing your own risk based on value, not just flows.
So the answer isn't really one or the other, it's a combination. Stock picking lets you exploit the inefficiencies right now.
And holding cash is your protection and your ammunition for the crash that is being mechanically built into the system. Both require you to make an active choice against the passive tide.
The default setting has become the riskiest choice of all.
It has. The future belongs for those who actively choose what to own, and maybe more importantly, actively choose when to hold their dry powder. You have to choose to be an owner again.
So the verdict seems pretty clear. The S&P 500 is not the diversified safety net it used to be. It's a crowded, broken momentum trade, dangerously concentrated in just 7 names, and it's sitting on a volatility spring that is ready to snap.
And the defensive playbook requires active choices. Pivoting away from cap weighting, hunting for value in neglected sectors, and crucially, holding cash to take advantage of the absurdity that the coming liquidity crisis will inevitably create.
So we'll leave you with this final thought. If you believe this index mechanism is broken, if you believe the diversification is a lie, and the liquidity is a mirage, then the passive path is no longer safe. It's a path of blind risk. You can check out anytime you like, but if you wait for the stampede, the door will be too small to get through.
So you have to ask yourselves, if the index is built on a fundamental lie, how much of your wealth should really be on autopilot? And how much should be protected by your own informed, active choices?
The free ride is over. The future belongs to the owners who are awake.